So if you haven't looked at the previous videos, please go and find them. They're all in this playlist. I've covered an introduction into the app. I've covered the ASISA categories, and then we've gone and looked into a particular fund, and I'm going to continue from there. So again, I'm just going to choose the fund by searching for M, Stanley Multi-Manager Balance Fund, and we've covered all of this, the general information, the asset location and assets under management, the performance to date and rolling performance over various sort of periods, as well as the calendar year returns and the returns to date, histogram of the monthly returns, the return funnel, the quartile ranking on a rolling basis, both absolute or nominal and active, as well as the risk return scatter plots, so return versus volatility and active return versus tracking risk, as well as the upside downside capture and the cumulative returns and the drawdown chart. So basically we've covered all of that. So I'm going to continue with the regression metrics here. Now this is very useful because on the fly, it will do a regression of the fund's returns over that period that's been selected. So in this case, the full 20 years, so 240 months worth of returns for the fund and a benchmark. And yeah, I'm actually not doing it just against the benchmark that you've selected. Again, just to be clear, this isn't necessarily the fund's benchmark. It's whatever benchmark you've selected from the many benchmarks available here. Average refers to the ASISA category average, the ASISA category that this fund is in, which is the South African multi-asset high equity category, or the median or CPR or any of these other numbers, right? So I'm going to do a regression. So this is a ordinary least squares regression against that benchmark. I'm also going to do it against every single index or all those sort of benchmarks that are listed above, but indices specifically, and find the best matching one, as well as all the funds in the ASISA category, and also ASISA categories themselves, the average return for ASISA category, just to see, which fund, which ASISA category does this fund regress the highest against. And there's two ways to test or to select the best in this case, when we're talking about the best index, best fund, and best ASISA category that it regresses against. You can either do it on beta, so you're trying to get the beta close to 100%, or you can do it on R squared, which is really the right way to do a goodness of fit test. The reason I include beta is you can have a fund that has got a very high R squared against a particular index, but a very low beta. So a good example, let's assume you've got a fund that's 50% equity, 50% cash. It might have a great R squared against equity, in other words, a great fit, but it's only 50% beta against equity. And that's important to understand. Many people confuse beta with correlation. They're two quite different. They happen to be the same at zero, but they can be very different at the sort of the other extremes, +1, -1, or even higher for beta. Beta can be 2 or 3 or 4, can be any number. Okay, so what have I got here? I'm showing you that against the benchmark, in this case, it's the average that I've chosen. I could have chosen CPI or any other benchmark. The alpha of the regression, now alpha here is in the linear regression, where the return of the portfolio, this is how you do the regression, equals alpha plus beta, which is the slope. So the alpha is the intercept, beta is the slope, times the return of the benchmark, plus some error term. Okay, and that error term is where you get the R squared, the sum of the squared, the sum of the squares of the residuals. So here it's giving you the correlation, it's giving you the beta, it's giving you the R squared, which is the correlation sort of squared, as well as the tracking risk. So a fairly good fit in terms of a low tracking risk to the ASISA category average. To the benchmark, to the index SWIX, which is the best matching index, it's a much higher tracking error. Why? because this fund is a balanced fund. It's not invested 100% in the SWIC, so it's got a fairly high tracking risk. What about to the Old Mutual Balance Fund? That's the best matching fund. If you had to compare two funds over that 20-year period, now 20 years is a long time, that would be the best matching fund. And then against the ASISA category, you can see very close to this, which was the category average. And then you can see the regression line here with the equation, as well as the R squared, as well as a quadratic fit to the data as well. And sometimes you've got a much better quadratic fit to the data. So again, you could look at that regression against the benchmark, against the index, for example. This is what I'm talking about. Over that 20-year period, the sensitivity or the beta to the SWICs would only be 0.62, so roughly 62%, call it equity exposure, but a much worse fit, not as good as the category average. Against the fund, this is that other fund, the best matching fund, the one above here, as well as the ASISA category, which looks a lot like this benchmark. Okay, now you could look at this over different periods. So maybe I just want to look at the last 5 years, and all of a sudden you might find the data is a much better fit. Why? This 20-year period's a long time. I mean, a lot of the regulations changed. You know, the fund could have changed the ASISA categories. The ASISA category itself could have changed over time. The foreign allocation went from 0% all the way up to 45%. So there could be a lot of changes. So you might want to look at a shorter period. And then here you've got some additional correlations, and you can choose which indices you want to do the regression against. So in this case, I'm choosing the main indices, but if I was looking at bond funds, I might want to look at duration. Equity funds, I might want to look at style and size. But in this case, I'm just leaving, this main. And this is an unconstrained regression, which means it allows, the regression allows shorting and allows leverage. Okay, whereas the constrained regression below it doesn't allow leverage or shorting. So this is basically looking for, over that 60-month period, the 5-year sort of period that we're looking over here, which independent explanatory variables would best describe, and the exposure to them best describe the performance of the fund. And you can see there the CELI, which is an inflation-linked index at 13%. Now, this fund would never have had 13%. So you got to know that this is just, what the data seems to be showing. The ORB02, which is the bucket that has the bonds from 3 to 7 years, 12%. The PCAP, which is the capped property index at 4%. That's probably in the right sort of region. The capped SWICs at 43%. That's local equities. Probably in the right sort of ballpark. USD ZAR 3%, and MSCI, which is global equities, at 25%. So total equities at about 68% seems about right for the fund. Okay, let's leave it there. We'll come back. No, in fact, let's just cover this last one. It's another machine learning algorithm called K nearest neighbors, and you choose the parameter K, essentially, and it will go and look in this space, the 60-dimensional space that represents the last 60 months. If we have to plot each month as a dimension, now you can only imagine maybe 2 or 3 dimensions, you can't imagine 4 or 5, certainly not 60 dimensions, but in the 60-dimensional space, if you have to plot every single fund, and look for the 15 funds that are closest to this fund, and then look at the ASISA category of each of those funds, and look for which category has the highest frequency. In other words, which category occurs the most often. And you find that it's actually the South African multi-asset high equity category. In other words, this fund behaves like many other funds in this category. This isn't always the case, so don't take this for granted. This is actually quite a nice algorithm that tells you about how different a fund is from the funds in its categories. So if specifically in this multi-asset high equity category, you've got funds with 0% equity exposure. So you might find that if you look at those funds, their K nearest neighbors might actually look like MA income funds or even money market funds or something else. They might not look like other high equity funds, or maybe they look like low equity funds, for example. And then finally, just the lowest tracking risk fund, it's just gone and calculated that for all the funds to find which one gives it the lowest tracking risk. So let's leave it there. We'll come back and have a look at the risk return metrics in the next video. Thanks, bye.